Today in this webinar, I'm going to talk about midstream investment and how the midstream investment landscape has changed over the last 30 years or so. You may have attended some of my other webinars, and one of the most recent ones I talked about how to value midstream investment. So quite a bit about that, but this one really focuses on what's going on from a changing standpoint. I just want to take a few minutes to introduce myself. I'm a midstream oil and gas person. I spent about 25 years with Conoco, most of that on the pipeline side of the business. I left at the end of 2003 and started my own consulting company. So I've been doing that ever since. Basically, we're working on helping people understand midstream, content knowledge about midstream. We do a bunch of independent analysis and assessments. We do some angel investments. Then we also do some management and improvement consulting. So helping people think about how to improve their business. I'm the chairman of Line Star Services, which is a super regional pipeline services company, basically working in Texas, Oklahoma, Louisiana, out in New Mexico, so kind of down all around the Permian Basin down to the Eagle Ford Basin. I was the president of Conoco Pipeline for about 7 years, basically before the merger with Phillips. I've written a number of different publications. I guess the two biggest ones are Oil and Gas Pipelines in Non-Technical Language, published by Penwell Publishing, came out in 2006. A very fun book to be able to write. And then I finished last year Natural Gas Local Distribution Pipelines in Non-Technical Language, also published by Penwell. I'm working on the second edition of Oil and Gas Pipelines in Non-Technical Language. Since 2006 timeframe, I've taught over 150 instructor-led classes. And so I've learned a lot over that time about how people learn, what they need to know, what they're interested in. So the second edition is going to have a lot more artwork in than the first edition, and I think people will find it a very, very helpful and interesting book. Here's a picture of the cover of the first book. When I'm talking with people, they're like, oh, that book with the red cover. So that's a picture of it. And then here's a picture of the cover of the second book. So when I wrote the first book, the transmission book, I always thought there needed to be another book that would carry the natural gas from the city gate, which basically is where the transmission function lets off. And I finally was able to get time to be able to write that. Came out last year. And then there's some contact information out at the bottom, my email as well as my phone number, if you want to get in touch with me. Always happy to talk with people. Little disclaimer, don't worry about it. It says basically I think all the material here is right, but if it's not, don't blame me. And it does say all this material is copyrighted. So happy for you to be able to direct people to the website to look at the tutorials. But if you want to get copies of materials or things like that, please contact me first. So let's talk about what we're going to talk about today. First of all, I'm going to talk about oil and gas midstream. So I'm going to try to put into context the whole midstream business and what parts there are in the midstream business. Then we'll talk about recent events and kind of the outlook going forward, probably the next 5 to 10 year time period for the midstream industry. It's changing. A lot has been happening in the midstream investment environment. We're going to spend quite a bit of time talking about that. So you can be thinking about how those changes might impact how you think about investing and how you think about the midstream environment. Then we're going to talk about industry performance. I'm going to focus on the unit performance for various selected companies and the index performance. So it's not really about the whole performance thing, but it's about the investment performance of selected midstream investment companies. Going to talk about sort of the positives and negatives that are presenting themselves as the midstream industry is changing. How do we value midstream? So we're going to take a brief look at valuing midstream, coming up with what it is that you might pay for a midstream asset or what you might sell a midstream asset for. Then we're going to talk about primary investment risk associated with midstream operating companies. So midstream operating companies, these are the people who actually, or the companies who actually own the pipelines, own the processing plants, own the fractionators, those sorts of things. Then I'm going to wrap up just with a slide or two around related midstream investment opportunities. So these investment opportunities are the companies servicing the midstream operating companies. So they would be suppliers, vendors, contractors, those sorts of things. And then we'll do a little summary at the end, kind of the point. So this is what I'm planning on talking about today in this webinar, which I'm going to then record as a tutorial and post up there for y'all to take a look. So let's first talk about oil and gas midstream. What makes up midstream? The reason I've thrown this in here, included this little piece, is I find that there's quite a bit of misunderstanding or differences of opinion of what goes into midstream. So I'm going to break this down. First, we have the transportation function. Then we have treating and processing things. And then storage, keeping this either operating storage, so storage we need to use to be able to decouple parts of the pipeline, as well as storage that we need to use to balance the supply and demand over the day and over the year. And then terminaling. Terminaling is basically putting this in usually to storage or another facility or taking out. So some people lump storage and terminaling together. I'm going to talk about them separately here, but often they are performed together basically in the same facility. So let's talk about transportation first. And I'm going to start with pipelines. And when I talk about pipelines, I like to divide pipelines into their function and what it is that they carry. So first, function. We have gathering lines, main lines, distribution lines. So the gathering lines typically start at the production processing pad and they go to the main line, the Autobahn, the big pipeline. The main lines then move the oil and gas from the gathering lines to the refineries, to the trade centers, to export terminals, and those sorts of things. And then finally we have the distribution lines, the small lines. In oil, that's rather limited. So we may have some distribution lines that take jet fuel, for example, to an airport or to an Air Force base. We may have a diesel line that takes diesel fuel, railroad diesel fuel, to a railroad facility. But in most cases, a lot of the distribution is done by trucks. On the natural gas side, the distribution lines are extensive. In fact, they are the subject of the second book that I wrote for Penwell. So these are the pipeline functions, and then the pipeline fluids. We're moving crude oil, refined products, natural gas liquids. So when I say oil, I'm talking basically about crude oil and refined products. And if you have any familiarity with the regulations, these are the fluids that the U.S. regulations called hazardous liquids. So when I'm talking about oil, I'm not necessarily talking only about crude oil. I may be lumping crude oil and refined products together. Natural gas then, this is primarily methane. And this is what we burn in power plants, in your home and mine, it comes to the stove, whatever it may be. Very ubiquitous, in use nearly everywhere in the U.S. And then we have natural gas liquids. So these are the molecules that at the combinations of pressures and temperatures we're talking about, they become liquids in the natural gas stream. We remove them and they go a lot to chemical processing plants, or they are the propane that you use in your propane grill. So crude oil, refined products, natural gas liquids. There are some other pipelines, of course, the CO2 pipelines and whatnot, but we're focusing here on the hydrocarbon pipelines. Then continuing on with transportation, we have marine, barge, and ship. We have rail, and there have been a lot of crude oil moving by rail. And rail is kind of interesting because if you go into Europe, the refined products is extensively distributed by rail and by barge in the river system and the railroad system. Not so much in the U.S. In the U.S., we had a big movement to move more crude oil by rail. Because particularly from places like the Bakken, we didn't have a lot of pipeline capacity built. And making huge investments in rail, and then when the price of oil fell off, if you want to lease a crude oil rail car right now, you can probably do it pretty cheaply. And then crude oil gathering. So we do use trucks to gather a lot of the crude oil, and then we have refined products delivery. So this is my view of what goes into the transportation part of midstream. And today, we're going to be focusing on the pipelines and not so much marine, rail, and truck. So one thing I want to point out is for the pipeline function, the rates, what the pipeline companies charge their customers, their shippers, are largely regulated by the FERC, the Federal Energy Regulatory Commission, on the interstate side of the business. And then they're also regulated by state commissions on the intra side of the business. So if you're looking at the value of these, the pipelines, rates, you have to remember, are going to be largely regulated. And then if we move on down to marine, truck, rail, and barge, the rates are generally not regulated. So just something to keep in mind. Moving on then to treating and processing. On the natural gas side of the business, we have treating, which might be when the gas stream moves along, or when the oil and gas stream comes out of the well, it may have carbon dioxide and hydrogen sulfide in it. And so these can both be corrosive materials. So we need to remove those fairly early in the transportation process. And that's what treating, sometimes called sweetening, does. We also have dehydration, which is removing any type of, or I shouldn't say any type, most of, I should say, the water that is in the stream. So this oil and gas is underground, right? When it comes up, it brings a bunch of other stuff with it, including water, so we have to separate that out. And then the natural gas liquids are removed commonly at what we call gas plants. So these are along the line, and they take the methane out, leave the rest of the stuff in the stream, and then put the methane into one of the pipelines, one of the transmission lines that we talked about previously. And then this other stuff that remains, these natural gas liquids, typically will go to a natural gas liquid separation facility, and we typically call those fractionators, although there is fractionation that also occurs in natural gas plants. So fractionators are going to separate the ethane from the propane, from the butane, from everything else. And then there's a little part that I've kind of put in here, compression, which is paying tolls, just paying a rate, a per unit rate, to be able to take the gas primarily at the field location, compress it, and move it on down the pipeline. So compression may be contracted, may be rented on a per unit basis, or the company themselves may own the compressors. Just kind of varies. So treating and processing on the liquid side, we have stabilization and blending. So stabilization means some of the times that the vapor pressure in condensate, for example, is going to be high enough that it would be dangerous or cause operating problems to move it in a regular liquids line. So we have stabilization on the natural gas liquid side and on the oil side, and there's plants to be able to do that. And then there's some amount of blending that goes on the crude oil side of the business, and that's a sort of a controversial topic around whether crude oil should be blended or not. Not the purpose to talk about that in this particular presentation. Then we have some butane blending that goes on at the petroleum products terminal, or even at the products pipeline, to be able to get the vapor pressure up there to basically the maximum vapor pressure you're allowed to have in gasoline. And then transmix process. Transmix occurs whenever the batches of gasoline and diesel, for example, are end to end. And so you may cut that out. You may take that little part of mixing, which we typically call in the industry interface, and put it into a transmix tank. So a lot of times people ask me, what's the difference between interface and transmix? My definition is it's interface when it's in the pipeline. It becomes transmix when you take it out and put it into a transmix tank. You can have interface between a regular gasoline and premium gasoline, but you usually do that, but that doesn't become transmix. You take that and put some of them in one tank and some of the other tank, so you may upgrade the regular gasoline a little bit by putting some of the premium gasoline in there and not separating it out as transmix. Moving on then to storage and terminaling, we have crude oil, refined products, natural gas, and natural gas liquids. And so crude oil and refined products typically we store as a liquid, and we store them in above ground storage. Big steel tanks, fairly straightforward, not very sophisticated from a technology standpoint. Been building them the same way for years and years. And then natural gas and natural gas liquids are usually stored in depleted reservoirs. So these are the reservoirs that the natural gas came from in the first place. depleted reservoirs in the case of natural gas, or caverns in the case of natural gas liquids. Caverns are mined, or they're leached out of primarily underground salt deposits. And so we wash out a hollow cavern, and then we can put natural gas liquids in there. So the different types, and then we have different storage functions. You can have short-term operating storage. You may need to put gasoline into a tank, take it off one pipeline, store it for a couple hours before you originate on the other pipeline. Or in the case of natural gas, we have a lot of fluctuation over the day and over the season, so we may need to put natural gas in storage or natural gas liquids in storage for short term for operating reasons. There's also longer term arbitration storage is, particularly when people are looking at crude oil and they think it's going to be worth more in the future, so they may rent or lease tankage and put it in there. And then long-term interseasonal, so this is more in the case of natural gas, because we use a lot more natural gas in the winter than we do in the spring and the fall. And then we use a bunch in the summer for running power generation plants to be able to provide air conditioning, for example. And then terminaling. With terminaling, we're receiving, we're storing, we're redelivering. So storage and terminaling, some people talk about them as the same thing. I've put them closely together here. It doesn't really make any difference other than we need to make sure we know what we're talking. And that wraps it up for a little bit of an explanation of at least what I think goes into midstream. Let's go on now to outlook and recent events. So I've kind of grouped the supply and demand things together. Looking into the future, I think most people agree that production in the U.S. is going to continue to increase. Maybe not go up quickly, but continued gradual increase out of our sort of forecast horizon, which is going to mean commodity prices are going to remain flat to moderately higher, probably because we don't see any big spike up in demand, although there will be, we think, continued demand for natural gas, primarily for electrical generation. And the demand for transportation fuels in the U.S., gasoline and diesel, increases slightly. Supply and demand kind of working here to be in balance. And then we think, kind of looking at a more sort of regional basis, strong oil and then associated gas production growth in the Permian, limited oil production growth in these other basins, and natural gas production growth continues from the Marcellus and the Utica. So this is kind of the background on the supply and demand type of thing when we're talking about what drives the price of hydrocarbon fuels. So with that backdrop, let's talk about what's going on, or at least what I think is going on in the midstream environment. Now I'm going to focus on pipelines, processing, storage, and fluids terminaling. I'm not going to talk really about truck and rail and barge and those others. We've seen a rotation of ownership over about the last 30 years from integrated majors to standalone entities. Standalone entities primarily master limited partnerships. So because of tax law changes in the 80s and what the integrated majors were trying to do, there's been a huge rotation of ownership. Back before 85 or so, nearly all of the oil pipelines were owned by integrated majors, and the natural gas lines were largely owned by people who provided a bundled service, buying the gas, transporting it, and selling it then to either the end user or, in a lot of cases, to the local distribution company, with no sort of transparency as what the production cost was. We've seen a rapid expansion through acquisitions and organic growth. Some of the early players got in and they acquired some assets and they were able to have considerable organic growth. And I think we all realize that in most cases, organic growth is going to be cheaper growth than acquisition growth. Rapid expansion that happens has been slowing down over the last period of time. Access to capital was very easy, and it has become harder for a couple reasons. One of those reasons is that the whole way of sort of compensating the general partner has driven the industry to have a higher cost of capital. And so one of the things that's happening is people are learning to deal with. We had the emergence of the drop-down entity. In the early days, we didn't really have these drop-down entities, but people have figured out how to do this, and in many cases have used drop-down entity as a way to be able to drive up their incentive distribution rights very, very quickly. A number of people did this, a number of companies recently did this masterfully. I think of Phillips 66, who formed an MLP a couple years ago, put some assets in, and then have dropped assets down over time to be able to increase their distributions, including increase the incentive distribution rights to the general partner. So the rising incentive distribution rights means a rising cost of capital. One of the big things I think that's going on if you're looking at midstream investment opportunities. So the MLPs then are trying to find ways to simplify and deal with the incentive distribution right rising. So through simplification transactions. For example, Magellan a couple years ago bought the general partnership. Buckeye bought the general partnership. Kinder Morgan went to a corporate form of ownership. So interesting things going on there. Some of the expansion challenges for the industry are driven by public opinion. It wasn't that long ago we were talking about Keystone XL and everything that was going on there. Dakota Access, you could go on and on with the list. So this whole ability to build pipelines has gotten much more difficult over the last number of years. There's been increased public safety, environmental regulatory pressure. We all know pipeline accidents are very, very rare, but when they do happen, they can be very serious. Just think of, instead of moving those millions of barrels from the Gulf Coast to the Northeast on Colonial Pipeline, if instead of doing that we were railing all of those or even trucking all of those, what a nightmare that would be. It's a real challenge here. We all want to be able to drive. We all want to be able to stay warm. We all want these good things, but we also want safety and environmental. So there's this quandary going on. And then we have a challenge in attracting the needed talent. I won't say a whole lot about that. We've gone through cycles. People may find operating in engineering jobs maybe not as interesting as building apps or investment banking or whatever. The real challenge in attracting the needed talent into the industry. These are things that I see changing when we're looking at the midstream. Now we're moving on to performance, and so I've just gone actually to my Charles Schwab account, interest of full disclosure, put in a couple here to see what's happened in the last 5 or so years. So you can see Buckeye is the first one in the upper left. They have finished that 5 years, so they're coming out in this graph a little higher. Then they went in, Kinder Morgan lower, then they went in Enterprise, about the same, Energy Transfer, a little lower, so we had a big rise up and then a fall down. So you can just look at that, what's happened. Tesoro, you can see relatively new. They came in to the period and then they're going out of the period higher than they came into the period. Same thing with P66, had a huge runoff, then a drop off. And so you can just read these and kind of think about what's going on in the industry in general. And then here is the overall index that's looking at what's happened with MLP. They've changed over time. I got this from the Master Limited Partnership Association website. You can certainly go there and learn more about Master Limited Partnership, the publicly traded Master Limited Partnership. So just a little perspective from a graphical standpoint on what's happened from an investment performance standpoint in the industry over the last period of time. Let's move on now to potential positives. What can help drive the industry? There's going to be a continued oil and gas infrastructure build out. Wells that were drilled are being completed now. We are hooking production batteries up to pipelines that have been trucked. There'll be a lot of continued infrastructure build out. There's a lot of activity from the Permian, for example, to the Gulf Coast for exports, up to Cushing for storage. There'll be continued build out. That's a positive. Exports, crude, natural gas, liquids, and liquefied natural gas. Building the infrastructure to be able to enable, if you will, exports is going to be a positive factor. There's going to continue to be a need for gas processing as we have increased gas production. A lot of gas processing infrastructure built, particularly I think of the Marcellus over the last 10 or 15 years, ever since Range Resources figured out how to frack the Marcellus in a successful way back in the early 2000s. Some over-leveraged assets may become available for purchase. This is a positive for some and a negative for others. We saw the last 10 years a lot of PE firms come and build facilities for handling all the production that was coming on. Pipelines, storage facilities, gas processing plants, and some of these assets became over leveraged kind of in the heyday. And so there's some rationalization that's going on there. Good for you if you're ready to participate in the rationalization. Too bad for you if you are forced to participate in the rationalization. And then restructuring to remove or reduce IDR. So this has been going on for the last probably 10 years, maybe a little less, so a lot going on from a positive standpoint. Potential positives for the industry. Moving on then to potential negatives. Uncertainty is always bad, right? Because uncertainty is coupled with risk, and so we're not going to take as much risk. Interest rates. These are very interest rate sensitive investments, and interest rates go up, or maybe I should say when interest rates go up, in order to maintain the yield spread above whatever the 10-year T-bill or whatever it is, we may see the price coming down. There is generally reduced need for new pipeline projects. So I said the infrastructure is going to continue to grow out, but it's not to the extent it did 10 years ago or so. When we have new pipelines competing with each other, we could potentially increase the rate competition among the pipelines. We'll see what happens there. Permitting difficulties for new projects, don't really need to say very much about that. We know that's going on. Increased levels of maintenance. So we are looking at spending more on the integrity of the asset. We're learning more. First of all, technology is allowing us to better understand the condition of the asset, which means then we can better know where to allocate our money and we can spend our money intelligently, but we are generally going up in the amount of integrity money we spend on the pipelines. And then potential infrastructure overbuilds. We may have lines that are not running as full or not using the capacity that was built. Supplier pricing. The vendors, the contractors have really been beaten down over the last 5 to 8 years by the supply chain people. A lot of that has gone on. We had oversupply of services and under demand of assets. And so the supply chain people were merciless in beating down the suppliers. Suppliers are falling out now, they're restructuring, they're going bankrupt. Potentially there we may have that piece of the component, the cost piece of the component, to the midstream companies coming back to more of a more normal what it had been historic. And then finally, shipper financial capabilities to stand behind the guaranteed volume. Some natural gas and crude oil lines were built. The shippers guaranteed the volumes. The shippers got into financial trouble because of the price of the commodity, and so they may not be able to stand behind the volumes that were guaranteed. So what looked like very unrisky projects have now become more risky projects. And then restructuring could trigger taxable events. As we go from an MLP to a corporation, or whenever we change the corporate form of ownership, we may trigger taxable events which the owners of the assets or the units were never expecting. Potential negatives we may want to think about as we're looking at the industry. Here's a little bit about what is the company or asset worth, and the answer to this question is the answer to most every question: it depends. What does it depend on? Obviously, it depends on financial results, past, present, and future. So we're looking at revenues, we're looking at expenditures, we're looking at new project backlog and prospects. What a company or asset is worth, I'm not going to tell you the equations to use. You all probably know that. What I'm going to talk about in this slide is the things that go into the equation. So the financial results go into the equation as we're looking at how much the asset is worth. We also then have some sort of intangible, non-financial things like the quality of the management. Do they have a good mix of financial, commercial, and operating talent to be able to run the company? Asset risk. What's the condition of the asset? What's the integrity assurance program of the company? What's the exposure that the asset has? And by exposure, I mean if you have a leak in the middle of the Hudson River, the exposure is a lot higher than if you have a leak in a wheat field somewhere in Kansas. So just thinking about what is the integrity and what is the exposure? What's the likelihood of an incident? What's the consequences of the incident? What are stakeholder relations among the customers, the regulators, Pipeline and Hazardous Materials Safety Administration, Federal Energy Regulatory Commission, and the landowners? What does the company have to do? What are they going to have to do from a resource standpoint to sort of keep these relationships with these regulators sound? And then what's the business form? What are the implications? Is it an MLP? Is it a corporation? What do we need to think about going forward from a business form standpoint? So those are just a little bit as we're thinking about valuing the company. Obviously financial results, but there's a deeper dive in some of these other things that we need to think about so that we're not generating more risk. And when I talk about risk, it'll look a lot like these same last four items. Here it is, business. So what are the volumes? What are the rates? What's the operating expense? What type of ongoing CapEx do we need for maintenance, integrity, expansion? How well has a company demonstrated they can manage projects and deliver a project in scope, within budget, on schedule, and well implemented? Then what are the business and financial risks for the capital markets? What's going to happen with interest rates and IDRs and the whole cost of capital things? What are the operating risks? People, assets. Do you have good people? Do they know what they're doing? Do you have good assets? Are they well taken care of? What about the market? Supply, demand, competitors. The Permian is really hot right now, right, from a supply standpoint. Incidentally, most of the new pipelines in the U.S. are being built because of new supply, not because of new demand. So only really on the demand side when it comes to power generation plants are we building new pipelines to serve new demand areas. What about the stakeholders? What about the customers, the regulators, and the landowners? What's our relationship with those people? I said I was going to touch just briefly on related midstream investment opportunities, and that's what this slide does. Let's talk about pipeline services. These are providers to the midstream operating company. New construction, maintenance and upgrades, integrity work. These are companies that employ welders, laborers, operators. They own or rent backhoes, welding machines, bulldozers, trucks, tools, all those sorts of things. These are the people that benefit a whole lot when the bubble is going on and a lot of stuff is being built. So we had a huge rise and we had a huge crash, and there's some restructuring going on right now. I just heard recently EMS, which was a company that rose up and had through a lot of acquisitions, just changed ownership. I don't remember who bought them, but somebody bought at least a part of them. So there's some interesting things going on here from a distressed debt and a bunch of other ways to be able to look at this. Technical services then. These are the people who do the engineering support, they do the surveying, the cathodic protection. So they are a level up, if you will, in the amount of technical expertise. So they don't own nearly as much equipment, if you will, as the pipeline service companies, but a big part of their assets are the people. And so we had Wilbros a couple years ago sell off part of their kind of technical services to another company that's kind of reformed and building that back up. So some interesting things. And then product and equipment, valves, meters, pumps, motors, LACs, ACs, all this kind of stuff that goes out there and installed on the pipeline. Investment opportunities there as things are changing from an ownership standpoint. So this is just a really little brief introduction. Got to be really careful in this space, know what you're doing. Probably a little harder to analyze when you're looking at this than we are on the operating company standpoint, because this is such a fragmented business. We don't have a rising tide at this time. Well, maybe it's starting to rise a little bit. We've seen a couple things going on there. We'll see in the next couple of years what happens. The bubble popped a couple of years ago. I mentioned the tide is not really rising. There is some evidence the market environment is getting a little better as things sort themselves out, so it'll be interesting to see what happens. Customer loyalty has been eroded by the supply chain. I mean, relationships are still very important, but they probably weren't as important as they were years ago. In the supply chain, people have come down and done a great job of beating us up from mercilessly. Challenge with this to make sure that your contractors still have quality programs and safety, because so much pressure on cost. The infrastructure is going to build out at a reduced pace, so it's going to keep on going. It won't fall off the table entirely. Got to deal with these cost of capital issues. This is bigger, I think, on the operating side than it is on the supplier side. Although the supplier side, from how much debt are they carrying, have a lot of issues they need to deal with. Drop downs add assets, but they drive up IDRs. You can almost see the trajectory of these new MLPs that come up, goes up, 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 and at some point IDRs have gotten to perhaps as high as 50%. Cost of capital has gotten higher to justify new projects, levels out, and then starts to drop. So very interesting thing that's going on there. So the asset growth is on the supply side, not on the demand side in the U.S. except potentially on the power side of the business. So that's a little summary telling what I think is going to happen. Very much enjoyed going through this presentation with you. I hope you enjoyed that short tutorial. Please subscribe so you'll be notified whenever I put up other tutorials. And do feel free to contact me in the meantime, Tom@pipelineknowledge.com. Always interested to hear your thoughts and ideas for future tutorials.